Zillow just detonated a bomb under the US housing market, and almost nobody is talking about it. More than half of American homes, 53%, lost value in the last 12 months, the worst collapse in momentum since 2012. Entire zip codes in Florida, Texas, and California are watching prices fall tens of thousands of dollars in real time. Inventory is at a 6-year high, mortgage demand is 30% below normal, and sellers are slashing prices at the fastest pace since the last housing crash. This isn't a soft landing. This is the beginning of a correction everyone swore would never happen. The most important detail buried inside Zillow's report isn't just that 53% of American homes lost value. It's how fast the market flipped. 12 months ago, fewer than 20% of properties were showing declines. Today, the majority of U.S. housing stock is moving in the opposite direction, marking the sharpest nationwide shift since April 2012. A market that was supposedly bulletproof is now showing unmistakable structural weakness. This reversal didn't happen gradually. It accelerated as key indicators aligned. Inventory rising by 15% year-over-year, active listings surpassing 1.1 million, and national price momentum falling to 0%. When appreciation stalls at the same time supply climbs, the market's balance point collapses. That is the hidden breaking point, where buyer demand and seller expectations diverge so aggressively that values fall without any major external shock. Even worse, the decline is broad-based. In states where prices surged the fastest between 2020 and 2022, the retracement is now unavoidable. Florida, Texas, Arizona, Tennessee, and Northern California are no longer isolated weak spots. They are the first signals of a much larger correction forming across the Sun Belt and the West. In these areas, thousands of properties have seen $20,000 to $60,000 evaporate from their estimated value since peak pricing. This erosion isn't caused by foreclosures or panic selling. It's caused by a fundamental mismatch between what buyers can afford and what sellers still believe their homes are worth. Zillow's national figures reveal something even more critical. When more than half of homes move into negative territory, the psychological equilibrium breaks. Homeowners begin checking their valuations more frequently. Agents start adjusting list prices earlier. The resistance to price cuts weakens. Once this behavior becomes widespread, downturns accelerate because every adjustment triggers the next. Meanwhile, condo and single-family values are diverging just enough to expose deeper structural fragility. Condos nationally are down 1.5%, while single-family holds a marginal 0.2% gain. This tiny divergence is not stability. It's early-stage segmentation, where weaker sectors fall first and drag the entire market downward. All of this creates a unified pattern: rising supply, weakening momentum, and shrinking buyer power. The 53% figure isn't a statistic. It's the line where the U.S. housing market officially transitions from overheated to overcorrecting, setting the stage for the next wave of declines that the industry still refuses to acknowledge. The first sign that the national decline was real came from the geographic pattern. Value losses didn't begin randomly. They emerged in the same states that experienced the fastest, most aggressive price inflation during the pandemic boom. And now those same regions are absorbing the steepest reversals. Florida is the epicenter. In several coastal metros, over 90% of homes show year-over-year declines, with condo valuations collapsing by 9.9%, the largest one-year condo drop since 2009. Entire buildings are seeing values fall $40,000 to $70,000 below peak, as insurance premiums spike, HOA fees surge, and buyers exit markets where carrying costs have doubled. This isn't a temporary correction. It's a structural affordability failure spreading across the state's major metros. Texas followed almost immediately. Cities like Austin, San Antonio, and Dallas now show widespread negative momentum as inventory surges far beyond normal levels. With 134,000 homes on the market statewide, sellers have entered a phase where price cuts are no longer optional. In many zip codes, valuations are down between 5% and 15% from peak, with some properties losing $25,000 to $50,000 simply because buyer demand is insufficient to absorb the listing volume. Even new construction is discounting aggressively, accelerating the regional decline. Then comes California, where the slowdown carries the most symbolic weight. After years of upward pressure, single-family values in key counties have turned negative, down 1.9% statewide, while condo prices are down 3.7%. Inventory has climbed to 71,000 active listings, the highest since 2019. At the same time, home sales have dropped to their lowest level in 12 years. That combination, rising supply with collapsing sales volume, is historically the trigger for deeper declines. Northern California in particular is now experiencing valuation losses across 90% of properties, a sign that the correction has reached even the most insulated markets. What ties all three states together is not geography, but sequence. These were the regions that overheated first, became unaffordable the fastest, and relied most heavily on speculative price growth. Now the declines are forming a connected shockwave, moving from the southeast to the southwest and finally to the west coast. It's a synchronized unwinding of pandemic-era excess, revealing how quickly a national downturn can spread when multiple high-exposure states begin losing value simultaneously. As the regional shock spreads, the clearest weakness inside the entire housing ecosystem is unfolding in the condo sector. While single-family homes are only beginning to soften, condos are experiencing a decisive, measurable contraction that signals broader systemic strain ahead. This downturn is not anecdotal, it is quantifiable. Nationwide, condo values have fallen 1.5% over the past 12 months, but that average hides far more severe declines in high-exposure states. Florida is the most dramatic example. In several metro areas, condo valuations have dropped 9.9% year over year, the steepest annual decline since the aftermath of the 2008 crash. Buildings that once commanded premiums are now trading $30,000 to $80,000 below their 2022 peaks. Insurance failures, skyrocketing HOA assessments, and mandatory structural upgrades have pushed ownership costs to levels many buyers simply cannot absorb. As a result, sellers are pricing units aggressively lower just to attract foot traffic, turning entire complexes into localized deflation zones. This pattern is not confined to Florida. In Texas, Arizona, and California, condo listings are accumulating faster than single-family homes, a sign that owners are attempting to exit ahead of deeper losses. In parts of Phoenix and Austin, the number of available units has doubled in under 2 years, while buyer inquiries have dropped sharply due to elevated HOA dues and persistent financing challenges. These markets are now seeing valuations fall 5% to 12%, depending on age, maintenance conditions, and local inventory pressure. The structural vulnerability of condos explains why this segment breaks first during downturns. Unlike detached homes, condos are tethered to collective financial risk. Insurance premiums, reserve requirements, maintenance obligations, and association governance. When these costs escalate simultaneously, as they have across the Sunbelt, affordability collapses much faster. Even small increases in monthly fees can erase buyer demand because lenders factor association expenses directly into the debt-to-income calculation. When fees climb, borrowing power shrinks. This is why condo weakness is the leading indicator for the broader housing cycle. The same forces pressuring condos, rising costs, shrinking credit capacity, and higher inventory, eventually spread into single-family markets. The condo sector is not an isolated decline. It is the first visible failure point of a system adjusting to higher operating costs and reduced demand. And as this segment continues to contract, it signals that more widespread value erosion is now structurally unavoidable. While condos reveal the first fracture, the broader concern is the quiet but undeniable weakening of single-family home values across multiple states. This sector doesn't collapse suddenly. It erodes gradually, until the rate of decline becomes too widespread to ignore. The latest data shows that deterioration has already begun in regions that fueled the national boom, signaling that the correction is no longer contained to high-risk segments. Across Florida, single-family prices are now down 4.9% year over year, marking the worst performance in the country for detached homes. What makes this significant is not the size of the decline, but the speed at which markets flipped from rapid appreciation to measurable losses. In several counties, typical homes that fetched strong offers in 2022 are now valued $20,000 to $50,000 lower as inventory builds and affordability collapses under record insurance costs. Texas is next in the chain. With 134,000 active listings, supply has exceeded demand to a level not seen since before the pandemic. Price momentum has turned negative in major metros, with year-over-year drops between 3% and 7%, depending on the zip code. Markets that once sustained intense bidding wars are now experiencing extended days on market, signaling that the underlying demand structure has weakened considerably. Arizona, Nevada, Georgia, the Carolinas, and Tennessee are following a similar pattern. These states show consistent negative movement in single-family valuations as listing volumes climb above long-term averages. In Tennessee alone, inventory is 50% above normal levels, leading to pricing adjustments that were unthinkable during the boom. In parts of North Carolina and Georgia, typical homes have lost $15,000 to $30,000 in estimated value over the past year, reflecting a tightening gap between what buyers can afford and what sellers are still asking. Even California, traditionally more resistant to downturns, has entered measurable decline. Statewide, single-family values are down 1.9%, with significant weakness in northern markets where sales volume has dropped to a 12-year low. The combination of reduced demand, elevated rates, and rising supply is dissolving the last of the pandemic-era premiums. This slow bleed is critical because single-family homes anchor the entire housing market. When values weaken across multiple states simultaneously, the foundation that supports national pricing stability begins to shift. The data now confirms that shift is underway, setting the stage for deeper and broader declines as inventory continues building across the country. As single-family values begin slipping across multiple states, the next question becomes unavoidable. How accurate are these declines? This is where many viewers turn skeptical, because the Zestimate has long been criticized as imprecise. But the actual data behind Zillow's accuracy tells a very different story when viewed at a national scale. And it's critical for understanding where the housing market is heading. Zillow publicly reports a 1.8% median error rate for on-market homes across the United States. That means when a property is listed for sale, Zillow's estimate typically lands within a margin of less than 2% from the eventual sale price. Even off-market homes, those without recent listings, maintain a 7% median error, a surprisingly narrow band considering the lack of real-time price signals. These figures are not speculative. They're based on millions of verified transactions. State-level variation further exposes how reliable these aggregated estimates actually are. In Colorado, the error rate falls to 1.3%, reflecting high data transparency and consistent listing activity. In New York, where inventory is older and markets are more segmented, the figure rises to 3%. But even that remains statistically tight enough to identify meaningful pricing shifts across counties and zip codes. At the macro level, these margins are far too small to explain away the widespread downturn now showing up in the national dataset. This matters because Zillow's accuracy strengthens significantly when thousands of properties are analyzed together. A dataset covering entire metros, or entire states, smooths out individual volatility and reveals broad directional movement. When 53% of homes nationwide show valuation declines, the signal is clear. This is not a glitch. It is a synchronized downward trend supported by massive sample size. Critics often point to isolated cases where a Zestimate jumps 20% to 30% when a listing goes active. Those scenarios do occur, but they represent the smallest segment of the dataset and reflect missing pre-listing information, not systemic inaccuracy. Once aggregated, these outliers lose influence. This is why the current value declines are so important. The Zestimate is not just a consumer tool, it is a national early warning system, and the system now shows softening across the majority of states. When an index with millions of data points tilts negative, It confirms the transition into a broader correction that no professional forecast can dismiss. With valuation accuracy established, the next force shaping the downturn is the rapid expansion of supply. No housing correction becomes visible until inventory crosses a critical threshold, and that threshold has now been breached. According to the latest national figures, active listings have surged to 1.1 million, a level the market hasn't seen since 2019. This is not a symbolic milestone. It represents a structural imbalance between available homes and qualified buyers. The year-over-year increase in inventory, 15% nationwide, is occurring at the same time buyer activity is contracting. Mortgage applications to purchase a home remain 30% below their pre-pandemic average, indicating that demand has not recovered despite moderating rates. When supply rises while demand remains historically weak, prices begin to slip regardless of regional conditions. This dynamic is the foundation of every broad housing cooldown. Months of supply, a key metric used by analysts to assess market tightness, has been climbing steadily as well. Even modest increases in months of supply reduce seller leverage, forcing more competitive pricing strategies. In markets where inventory has surpassed long-term norms, such as Tennessee and Texas, the impact is immediate. Higher listing duration, more price adjustments, and broader valuation declines. In Tennessee, available homes are 50% above typical October levels, while Texas now carries 134,000 active listings, a number that fundamentally reshapes the negotiating environment. This surge is not limited to a handful of states. Even high-cost regions like California are experiencing substantial supply expansion. With 71,000 active listings and the lowest sales activity in roughly 12 years, California demonstrates how inventory pressure can override traditional demand factors. When more homes sit on the market for longer periods, buyers gain the upper hand, and valuations begin to reflect that shift. What makes this inventory build particularly significant is the timing. It is occurring before any national rise in unemployment, before widespread distress, and before the typical recessionary triggers appear. The supply surge is being driven primarily by affordability exhaustion, elevated operating costs, and delayed seller capitulation, not by a wave of forced sales. This is why the declines showing up in Zillow's data are accelerating. The market is no longer constrained by low supply. It is being reshaped by an oversupply of expensive homes relative to what buyers can sustainably finance, setting the stage for deeper adjustments as more listings hit the market heading into 2026. The expanding inventory base is not just reshaping the present, it is compressing the timeline for what happens next. Housing downturns rarely accelerate during the first phase. The shift begins slowly, then gathers speed once the underlying mechanics reach a breaking point. That breaking point is now forming for 2026, where multiple pressures converge into a single directional force. The first pressure is delayed seller capitulation. Throughout 2024 and 2025, owners resisted adjusting prices, relying on the belief that demand would return. But with valuations stagnating and carrying costs rising, resistance is weakening. Every $1,000 increase in annual insurance premiums, every HOA adjustment, and every tax reassessment pushes more owners toward realistic pricing. When enough sellers reach that stage simultaneously, price reductions become self-reinforcing. The second pressure comes from absorption rates. With mortgage applications still 30% below normal and listings at 1.1 million, the market cannot digest the current supply at existing price levels. As more homes enter the market in early 2026, historically the peak listing season, months of supply will climb further, giving buyers unprecedented leverage. The third pressure is structural affordability. Median home prices remain far above wage growth, with inflation-adjusted valuations still 80% over the 100-year national average. This gap ensures that even small increases in supply produce outsized downward pressure on prices. Affordability constraints do not relax on their own. They force the market to reset. These dynamics create a pressure cooker effect. A slow decline persisted through 2024 and 2025 because sellers resisted reality. But 2026 is the moment when inventory, weak demand, and unsustainable costs collide. The result is not a gentle correction. It is a shift from gradual softening to measurable, rapid decline, driven entirely by market fundamentals that can no longer be postponed or ignored. As the 2026 pressure builds, the national map is splitting into two distinct categories: markets absorbing the correction and markets still resisting it. This divide is not random. It follows quantifiable patterns driven by affordability, supply constraints, population flows, and structural cost burdens. The strongest performers today are a cluster of states with stable inventory, moderate pricing, and lower operational costs. North Dakota, Connecticut, Alaska, Pennsylvania, Nebraska, Rhode Island, Iowa, and Kentucky all show positive year-over-year appreciation in both single-family and condo values. Many of these regions maintain price points that are 30% to 50% below national averages, meaning home ownership remains accessible without stretching debt capacity. Their inventory is aligned with historical norms, preventing the imbalance now eroding valuations in more inflated states. These markets also avoided the extreme price surges of 2020 to 2022, leaving them insulated from the sharp reversals seen elsewhere. On the other side are the clear losers, states where valuations surged far beyond local income levels and are now retracing. Florida's condo crisis, Texas's oversupply, and California's weakened sales volume place them firmly in the declining category. Arizona, Nevada, Tennessee, Georgia, and the Carolinas exhibit the same trajectory: rising listings, shrinking demand, and valuations slipping between 3% and 10% depending on the region. These areas carry elevated risk because costs tied to insurance, taxes, maintenance, and utilities have grown faster than wages, compressing buyer capacity and forcing pricing adjustments. This bifurcation matters because it signals that the correction is selective, not universal. The downturn is concentrating where price inflation exceeded economic fundamentals, while more balanced regions remain stable or even strengthen. As the national market transitions into its next phase, this split will become more visible. Resilient states maintaining modest appreciation while overheated markets absorb the majority of downward pressure. The map now shows not one housing market, but two diverging realities shaped entirely by structural affordability and supply dynamics. The growing divide between stable and weakening markets exposes an equally important factor driving the downturn: seller psychology. Even as valuations slip, a large portion of homeowners continue pricing their properties as if the peak never ended. This behavior doesn't slow the correction. It accelerates it because overpriced listings remain on the market longer, inflate inventory, and ultimately force deeper future reductions. The core issue is loss aversion. Homeowners psychologically resist acknowledging a decline because doing so means admitting the asset they believed was rising indefinitely is now worth less. In markets like Austin, where values have dropped 25% over the last 3 years, only 48% of post-2020 buyers are listing at a loss. The rest continue to price above market reality, creating a wave of stagnant listings that distort local pricing signals. This reluctance is reinforced by outdated expectations. Many sellers anchor their asking price to the highest valuation their home ever reached, even if that number was the result of a short-lived surge fueled by record-low interest rates. When mortgage costs more than double and insurance premiums rise by $1,000 to $2,500 a year, those assumptions collapse. But seller expectations don't adjust as quickly. The result is a market filled with aspirational pricing rather than data-driven pricing. Extended listing times are the direct consequence. Properties that would have sold in under 7 days in 2021 now sit for 30, 60, or even 90 days in declining metros. Each additional week on market reduces perceived value, pushing buyers to negotiate harder or wait for further cuts. This shift in behavior creates a feedback loop in which overpriced listings contribute to inventory pressure, which then forces future sellers to reduce more aggressively. This is why market psychology is not a side factor. It is a central driver of the correction. As more sellers confront stalled listings and failed price strategies, resistance weakens and widespread repricing begins. That shift is precisely what transforms a slow-moving downturn into a rapid, visible reset. The combined forces of declining valuations, rising inventory, and shifting psychology now converge into a measurable, data-driven forecast. The national picture is no longer ambiguous. Every major indicator points toward a market that must adjust downward to restore affordability and rebalance supply with actual demand capacity. The first signal is national stagnation. Home values, flat over the last 12 months, now sit 80% above their inflation-adjusted 100-year trend. No market sustains that gap without correction. As inventory continues climbing beyond 1.1 million listings, the pressure on sellers intensifies, especially in metros where supply already exceeds historical averages. The second signal is absorption deterioration. With purchase mortgage applications still 30% below pre-pandemic levels, even a moderate increase in listings will widen the supply-demand imbalance. Months of inventory has already moved into territory associated with softening conditions. A further rise in 2026 would transition several metros from mild declines to consistent, measurable depreciation. The third signal is the structural cost environment. Insurance, taxes, utilities, and HOA fees have risen faster than household income for 4 consecutive years. In Florida, annual ownership costs for typical homes have jumped by $4,000 to $8,000 since 2020. These increases are not cyclical. They are permanent upward adjustments that reduce borrowing power and compress price ceilings. The fourth signal is the concentration of weakness. Declining states represent a disproportionate share of U.S. population growth over the last decade. When high-growth regions cool simultaneously, national demand contracts in a way that cannot be offset by smaller, more stable markets. Together, these metrics form a single conclusion. The soft correction is evolving into a broader reset, not a crash driven by panic, but a recalibration driven by math. A market forced to bend back toward fundamentals after years of distortion. Every indicator is moving in one direction, and for the first time in a decade, the housing market has no escape velocity left. The reset is locked in, the pressure is rising, and what breaks next will redefine affordability in America for an entire generation.